We are now within the 48-hour window in which President Trump had said he would respond to that deadly chemical attack in Syria that killed 43 civilians. That's only one of the big three so-called headline risks out there, along with the threat big tech investors see coming after Facebook's privacy mess. And we can't afford to forget the tariff tantrums that the market has been prone to lately. Matson Money's Mark Matson about to tell you how he's investing through all the fear. Mark, $8.7 billion in assets under management. Which one of these headlines has the most power to panic?
Well, I don't get paid to panic. So, in fact, I get paid to do the exact opposite. And I tell investors, look, there's a concept called the investor prediction theory, which means that most investors think the only way you can make money in the market is to have a short-term prediction. The reality is nobody knows how this stuff's going to turn out. When you stop trying to predict short-term, gyrations in the market and you look towards 10 or 15 or 20 years, then downturns aren't scary anymore. As a matter of fact, they're seen as opportunities. So if these headlines do make the market go down, we're going to be taking fixed income and buying even more as it drops.
But to be forewarned is to be forearmed. And we have seen, I want to say in the last 2 weeks, 3 particular days where trade tariff threats, whether it was by the Chinese in response to the U.S. or vice versa, really hit the markets hard.
Yeah, it did. And look, trade wars aren't good for anybody. In fact, they hurt the consumer in China and in the U.S. It makes goods more expensive. And we're capitalists here in America. We can compete. Let us compete. We don't have to have a tariff to compete with the Chinese. But what investors need to be focused on is the reality that no one can predict what's coming up. So they need to own a globally diversified portfolio, not just in the U.S., and then have enough money on the side in fixed income to rebalance and buy more.
Cisco and Intel are your picks. Both have been up pretty dramatically over the past 52 weeks, with, I want to say, Cisco up 29% year over year, Intel up 43%. You still say buy?
Well, the whole industry, the whole tech industry has been depressed. Facebook's just one of the many that have been hit hard. And in our portfolios, we buy equities that have high book-to-market value. So they have big book value but depressed price because they're distressed. And that higher cost of capital equals long-term higher profits. That's another basic tenet of capitalism. So their cost of capital, they're kind of dogs still. They have a higher long-term expected return.